Welcome back to America's Commercial Real Estate Show. I am Michael Bull. This segment's brought to you by BOMI.org. That's B-O-M-I. They are the industry standard for education for facilities and property management. Check them out. Today we're talking about multifamily, the apartment market. Please welcome my next guest. It's Doug Ressler. Doug's Director of Business Intelligence with Yardi-Matrix, and he's joining us on the phone. Doug, thanks for being with us.
Michael, as always, thank you. It's a pleasure to participate.
And Doug, let's start off by getting your general view, and then we'll get into some specifics and some forecasts and some trends. You know, it seems like this has been a great long cycle, and maybe people are just getting nervous and seeing a lot of cranes in the air for new multifamily properties around the country, especially in the larger markets. What do you see for the apartment market moving forward? Is the sky falling?
No, absolutely not. We see 2019 is going to be much the same as 2018. Of all the dynamics that we measure and metrics, we see no inflection in terms of any of the major markets for things like employment, GDP, things like that. The economy's strong. There's nothing on the horizon right now that points to a dramatic shift in terms of the cycle. I know that everyone says, you know, it has to be, but when is it? There is no evidence. We find no evidence that that's the case. We think that the rental market is strong. It's going to remain strong to 2019.
So you don't see too much new supply?
We see new supply, but right now it's going to average out. 2019, in terms of new supply, is going to average out to about the same number as 2018, about 300,000 units. Plus or minus, in 19 as well as 18. We see the dramatic shift in terms of a lot of micro units, things like that, especially in dense areas, gateway cities that don't have an opportunity to have a lot of land. So we see a lot of micro apartments being considered, especially with zoning restrictions and things like that. But no, we see the number of new units continuing, and we don't see much of an impact. We think absorption is going to remain the same, very positive, and rental rates are going to continue to climb. Not as robust as they have in the last 3 years, but they will continue to climb.
Yeah, so Doug, put that in perspective for us. What have you been seeing for rental rate increases percentage-wise each year, and what do you expect moving forward?
We expect about a 2.8 this year, and then about a 2.77 next year, and 2.74 in 2020. And then occupancy is going to run about 94.6, 94.8, or if you're a vacancy tracker, to the inverse of that.
Yeah, and that includes A and B properties?
Absolutely, includes A, B, C, all those. It does, you know, we even go out and track affordable, but right now, workforce, A's and B's, C's, D's, that's all in that number. We keep on the side affordables. We do track them, but that's not in that number that I just gave you.
Okay. And it seems like this market, it just continues to grow. When you guys are looking at the market and you look at the percentage of renters in various cities, what do you see there? What's the trend? What stands out to you?
Well, a couple of the new South cities, the Southeast in particular, as well as Texas. In the top 10, one of the markets that stands out in terms of percentage of renters is Austin, which is surprising. We thought that the top 10 would include major urban cores, dense gateway cities. Austin, 54% of the people in Austin rent.
54%.
And we don't see
wow.
really an end to that in place.
Yeah.
I think, you know, it's that type of demographic, that type of market. Also in the D.C. area, we see a tremendous influx of you know, family, 4-bedroom, 3-bedroom, shortage. Lease renewals and lease duration for larger 3- and 4-bedroom families in like Alexandria, D.C. proper are at a premium. So we think that when you look at alternatives to demand in terms of buying or renting, it still stays with renting.
Interesting. We talked with Doug Ressler, Director of Business Intelligence with Yardi-Matrix, about the multifamily market. So Doug, the trend for tenants, used to think of tenants as being young people, right? And when they started
Right.
getting past 25 or so, they started moving out and getting houses. What are the trends these days?
Yeah, what we're seeing right now in terms of, especially with amenities, is the renters don't want pool and rock climbing walls per se. There's more millennial couples, operative noun being couples, that are having children. So they're looking for 2, 3, and 4 bedrooms, which are scarce. And so much of the supply is going to be at the top end of the market, Class B renters, things like that. But the amenities are such that they're changing more to be a family-centric type of attraction as opposed to just a single family.
Yeah, that's interesting.
Single person.
Are there certain markets or cities, Doug, where you've seen there might be some opportunities for more growth?
Absolutely, especially in the Southeast. We see opportunities for growth in terms of Atlanta. We see Austin being a particular area, Phoenix. And what we see is in those particular markets, you see not just a business orientation in terms of trying to adapt to population increases, but you see policy and business working together in sync to be able to provide opportunities for housing to people.
Interesting. Well, everyone keeps hearing and talking about the increased construction cost with labor and materials and just the cost of building today with some of the municipalities. What impact could that have moving forward, Doug? Or is that one of the things that's maybe keeping new supply at levels that keep the market going well?
No, it does have an impact. I won't just tell you that it doesn't. But at the same time, the demand keeps growing, especially in workforce and the affordable area of people that cannot afford to buy, that are looking for housing and housing opportunities. And you see different types of creative strategies. You see more micro units going in, especially in dense urban areas like Manhattan, Queens, that type of area. And also in Portland and Seattle. So what you see is the market reacting and adjusting to construction costs by looking to build smaller square footages to be able to maximize the number of units that they have with the dollars that they have to invest.
Okay. And what do you forecast for investor interest in multifamily versus other property types? It seems like buyers for multifamily are just incredibly aggressive and assertive, and it's really kept cap rates low. Do you think that will continue even as interest rates edge up?
Yeah, absolutely. We don't see anything within the TBill rates right now that, the 10-year treasuries is going to say, well, there is slight compression. But at the same time, there's no significant difference that's going to make people throw themselves out of second or third story windows.
Right. Yeah, if you're a seller and maybe you're looking for that top of the market, you haven't missed it yet, is what you're telling us.
Correct.
And of course, that matters what type of property and city. Well, Doug, what would you leave our audience with related to multifamily moving forward?
Well, I think multifamily, this is going to be another good year. I think that, housing and underwriting is going to continue to make it a very lucrative market. And I would just say that, in terms of investment and return for fiduciary responsibilities, it presents one of the most optimum investment portfolios that you can have.
All right, great. Well, all the multifamily owners around the country are applauding you right now. Doug, thank you very much, sir.
You bet. Thanks, Michael.
All right, that's good news. Well, stay with us. We'll have more on the multifamily market. I'm Michael Bull. This is America's Commercial Real Estate Show.